In today's video, we're going to be looking at the crazy buy-to-let situation and how it could impact the property market, along with some tips that I think are worth sharing and some things that I'm actually personally doing myself with the market the way it currently stands. Okay, so the first article we have is Retiring Landlords Risk Fueling the Rental Shortage. So I did a quick short on this, as you've probably seen, but this comes off the back of some research done by Hampton estate agents, who estimate 140,000 people who bought their properties in the 1990s to rent out sold them last year, essentially to fund their retirement. And they did further research alongside the Office of National Statistics, and this was a surprising statistic for myself, as the entire rental market currently has a pool of 2.75 million landlords. And essentially the doom and gloom behind this report is that 96,000 landlords who will turn 65 this year, added to the 924,000 who are already aged over 65, Hamptons essentially believed that we would be seeing more landlords retiring or exiting the market. And they also had statistics that between 2010 and 2022, the number of landlords retiring annually actually doubled. And in relation to what they were actually fearing, it wasn't just so much that the landlords were leaving the market. Hampton stated that the gap left by landlords leaving the rental sector was not being filled by a new generation of investors. Now, I did highlight above here that younger people, let's be honest, many of them don't have the money to invest in rental properties. So that's definitely one of the main reasons the gap isn't being filled. The second reason is the numbers don't stack, as Miss Beveridge states here. And then one quote I just want to touch on, and this might upset some tenants who absolutely hate landlords if you're watching this. For nearly the past 3 decades, spokesman Dan Wilson stated, the government has relied on amateurs saving for retirement to provide a large proportion of the nation's homes. The real problem is the chronic failure to build enough homes in places where people want to live. And I certainly share those sentiments too. I'm not going to get into a debate of landlords versus tenants. I think there's good and bad on both sides. We've had the doom and gloom, and I just want to run through some examples and statistics in this one, which if you are considering investing would definitely be useful. So 8% of landlords are at serious risk due to higher rates. Again, this comes from Hampton's report. And mortgage interest above 5% for some landlords now is becoming loss-making in terms of their portfolio. So this is something really, really important, because if you're making a loss on an investment, what's the number one thing you're most likely to do? Potentially sell up. Now, between 2000 and 2022, the number of privately rented homes in England more than doubled to 4.6 million. And 2/3 of existing landlords are now reliant on a mortgage, according to the latest English Private and Landlord Survey. Now, I don't know much about this survey, if I'm being completely transparent. However, what this does tell us is that we're not getting cash buyers, and many people are leveraging. Now, obviously property, one of the great benefits behind it, if done right, my friends, is the art of leverage. Now, the average 2-year fixed buy-to-let mortgage with 40% deposit, a lot more than I would assume most people are doing, or the people I know, has a rate of 5.2%, according to Money Facts. And that means that landlords are paying more than double the 2.5% just a year ago, and even more compared to the 2.12% average in 2021. So this is a massive increase. And if you want to know exactly how much the higher rates are hitting landlords' profits, well, then I'm going to share that with you. Although a mass landlord exodus is unlikely, according to this article, kind of going against what Hampton stated, higher interest rates will cause major shocks this year and put considerable strain on landlords who have borrowed heavily, essentially those who have over-leveraged. And here's a quick example that I think will be useful, my friends. Somebody coming to the end of a 2-year fixed rate on a buy-to-let, ready for refinance, and let's say that property is worth 200,000 with a 40% deposit, which is £80,000, at a rate of 2.2% on a 25-year term. All sounds pretty standard stuff there. The investor would likely be paying £2,666 each year in interest, according to Hamptons. Now, with the mortgage rates closer to 5% and some over 5%, their annual payments would actually be more than £6,000. 6,060 to be exact. So that's a huge difference. And if we look at rates from 6% or more, then that will certainly push people into loss-making territory. Now, this little infographic that I'm going to bring up on the screen essentially shows the estimated annual post-tax profit against the tax status. So we've got the lower rate, we've got the higher rate, and we've got those who purchased it in a limited company. And friends, you don't have to be a genius to recognize that as the mortgage rates start to increase, then of course, so do the losses. Next up, how can we cushion the blow? So obviously, as many of you probably know, rents are rising, and the average UK rent is now £1,184 per calendar month, according to HomeLet Rental Index, which is almost 10% higher than a year ago and almost 20% higher than the typical rent in March 2021. And I did highlight this here because this is quite interesting, I found, at least for myself. The average landlord now needs to be earning a yield in excess of 4%. And we are going to touch on some yields and the best places to invest after this, and that is necessary to turn a profit. Whereas in 2020, you only needed 2% to make a profit. I completely butchered that quote, but you can see it on the screen here. Now, what's interesting is if we look at buy-to-let returns over the last 5 years, things have massively changed. On the left-hand side, we have the total pre-tax returns. And on the bottom here, running along, we have capital growth versus rent. So as many of you know, I always state that capital growth is where you're going to be making most of your money, generally speaking, across a buy-to-let. So we can see that generally across the board in the last 5 years, things have actually started to change. And Hamptons believes the rental income will now play an increasingly important role in the coming years as house price growth slows down, something I will touch on in a few moments' time. So, as for a landlord, if you are an aspiring landlord, which, well, although I love investing, being a landlord isn't probably the greatest part of that. Is it hard to get a mortgage? Let's have a look at that. Friends, I just want to quickly interject as I have started a partnership with Lendlord. You may have heard of these guys before, and I have done a webinar if you want to check it out, which I'll link in the description. Now, you can get 3 months free to use their services, and I've actually uploaded my portfolio on there, and it just helps me analyze which of my property deals are performing the best and which ones aren't. And also one nice feature that I like is when it comes to refinancing, as many of you know, I am refinancing 2 new builds right now. You can also go through their finance system as well, and it can give you some quotes from their brokers. So I think it's useful. You got 3 months free, nothing to lose. Check it out. So affordability for a buy-to-let mortgage, as you may or may not know, is usually assessed by looking at the interest coverage ratio. So remember when I used to say that you don't necessarily need a huge income, and they look more at, does the gross rental income cover the mortgage interest payments? That's essentially what ICR means. And while this can vary from lender to lender, the average lower rate taxpayer will need the rental income to cover the mortgage payment by 125%. A higher tax rate payer typically sees this rise to 145%. And these are the kind of criteria and things that lenders or your broker will start looking at when you're putting in an application. They want to be making sure that not only are they covered and mitigating their risks, but also that you're not loss making either, because that's not going to be good for them, because essentially you're going to give up the mortgage. Now, this next infographic, again, there's some brilliant ones here that I just found really useful and I thought they'll be good to share with you guys, is the maximum loan to value required to pass stress testing. And essentially we've got the LTV on the left-hand side, and then we've got the areas, and we've got March 2022 and then March 2023. Within a year, my friends, look at the difference. In London, you could get just under 80%. That's probably what, 75%. It doesn't have the exact figure. Whereas now you're looking at just over 40%. So essentially you're going to need to put a lot more in. So from a lender's point of view, a higher interest rate means the goalposts have definitely moved when considering if an investment is viable. Now, adding 2% to the current average mortgage rate on a 2-year fixed of 4.84% reduces the number of viable mortgage options available for new investors, given that the average gross yield in England and Wales is 6%. And the reason that 2% exists is because typically lenders are stress testing their customers to ensure their investment remains profitable, something I mentioned a few moments ago. And typically they add between 1 and 2%. So we're just using 2% for this example. Now, thanks to higher interest rates and stress tests, a property's yield in 2023 therefore carries more weight and ultimately determines whether an investment is viable. And this is a great example, so do spend a bit of time with this, my friends. An average gross yield of 6%, an investor with £200,000 property would be generating £12,000 a year rental income. And with 25% deposit and a mortgage rate of 4.8%, they would likely be paying £7,330 annually in mortgage interest. However, to pass the interest coverage rate, the ICR I mentioned earlier, at 125%, the lender would require the rental income to be £9,170, which actually rises to £10,360 to pass the additional 2% stress test. So it's making things harder. So if the rent hasn't increased in that area for whatever reason, or you're overpaying in that area and you can't quite get the rents, you're going to struggle to pass that stress test. Now, for a higher tax rate payer, they see the benchmark move to 145%, but this makes their minimum rent required equal to 10,360 for the stress test value. So essentially, if you add 2% on that, it's going to be more. Now, generally, the average higher rate taxpayer investor will now need to earn a gross yield in excess of 7% in order to make even a small profit in 1 year. Basic rate taxpayers have more wiggle room and only need a yield greater than 5%, which opens up obviously more locations across the country. So, is there any positives around this? Well, rates could be heading down. The average rates on 2-year fixes have gone from 5.81 to 5.62% according to Moneyfacts, and 5 years have dropped from 5.72% to 5.58%. But at the minute, we're still in a much higher situation than we once was a few years ago. So moving on from that, let's look at the net profit from rental income by purchase year. So as you can see, those who have 75%, which obviously was was almost the norm in the last few years, they're going to start making a loss essentially. Whereas those who have decreased their current LTV, loan to value, they're essentially doing better off. Now, obviously this differs for low rate taxpayers, high rate taxpayers and limited companies. So if you are a high rate taxpayer and you're at 75%, it's certainly not going to help you. Whereas the lower rate or those in limited companies may still get by. So let's talk about something that I mentioned a few moments ago in relation to why the rental yield is now becoming more important than the capital appreciation. House prices simply aren't rising as much as they once were. In the past, landlords tended to make much more from house price gains than they did from rental income. But according to Hamptons, this is now changing. While the impact of higher interest rates on house prices is still open to debate, Hamptons says it's increasingly likely that rather than a short, sharp correction or a crash, higher rates are more likely to weigh down on the price growth towards the end of this house price cycle and into the start of the next year. So they're thinking things will flatline, maybe slightly come down, nothing too crazy as we head into 2024. Interesting stuff. Now, just leave this on here if somebody is interested. Again, house price growth appears to be slowing compared to previous property cycles, according to their research that they've done, therefore meaning higher mortgage rates will definitely weigh on this further. Now, one thing you've probably all got your own opinion on is, will there be a mass exodus? Who knows? That's the true answer. However, younger investors who are stretched at borrowing to purchase a buy-to-let property more recently are definitely at higher risk. Whereas older landlords, especially those who haven't continually released equity, will obviously be less affected. And the latest government, again another stat I was unaware of, stated the age of the average buy-to-let investor was 59, with just 15% under the age of 45. That completely shocked me. I was not aware of that at all. So it's going to be interesting to see how new investors obviously cope with this, and also whether those who haven't invested yet are actually interested in getting involved with buy-to-lets, because you get a lot of backlash from the media. Section 24 has obviously made things more difficult. You're not making as much profit. There's a lot more legalities around it. And let's be honest, tenants also have a hell of a lot of power. So is it something that people actually want to do? That remains to be seen. Now, Hamptons does estimate that 8% of landlords are at serious risk due to higher interest rates, representing about 450,000 rented homes. That's a huge amount of people to be struggling. So it'd be interesting to see if anything is put into place to maybe help with that. But that would be certainly something to watch out for. And Hamptons also states that a further 22% of landlords are at risk, though not serious risk, due to higher mortgage rates. So again, not too much optimism coming from the Hamptons report. Now, just in relation to yields, because obviously that's quite important, and I think this would be important for this video, there's 28 areas here that SDL have done a report on. And essentially, a question I get asked a lot, especially from a lot of my students, is what kind of yield should I be looking for? Is this a good deal based on this yield? And of course, that opens up another can of worms. But if we just look at it for the purpose of this video, as of 2023, the current average rental yield in the UK is 4.75%. So what I'm not going to do is obviously run through these individually, but Edinburgh takes the top spot with Birmingham and London finishing on the podium. We've then got Newcastle upon Tyne. We've got areas like Manchester, Leeds, Lancaster. We've even got Wolverhampton in there, which obviously surprised me. But just quickly, if I go back to the top, there's a huge difference between the 9.89% yield that you're getting in Edinburgh compared with everywhere else, especially in the top 10. You know, they're all within 0.8%, whereas that is well ahead. But you are looking at more expensive properties. So again, that's something to factor in. And then the list goes on where you've got Nottingham, Southampton, all these areas here, my friends, as you can see. I'll try and scroll as slow as possible, but I'm sure you probably picked them all up. Now, to kind of conclude based on what we've discussed in this video, one of the things I'm really looking for is the evening of power from tenants to landlords, even just making it 50-50. At the minute, I'm going through a situation myself where I'm actually most likely going to lose about £6,000 to a non-paying tenant. And it's actually the first time it's happened in over 10 years. I've been quite fortunate in that respect, but what I've realized is tenants truly do have all the power. Now, whether I'll get that money back or not, that remains to be seen. However, what I have realized is, along with all the stuff we mentioned in this video, you can definitely see why having a rental property when you don't have the power to evict non-paying tenants or tenants that aren't complying is definitely a dangerous game. Alongside this, I also think the BRRR strategy is by far the one that you should be focusing on, as it allows you to recycle your cash and essentially leave not only less risk in that property deal, but also less initial money too. Finally, one of the things I'm looking at is more cash flow. So it's about pivoting in today's market. So one thing I'm looking at is serviced accommodation. I'm heavily moving and pushing that part of our business. We've been doing it for 4 years and we do have JV opportunities available for that.